So today we'll be talking about leverage buyouts or LBOs. This is basically the private equity trick that Wall Street absolutely loves. LBOs is basically how investors buy billion-dollar companies with someone else's money. Right? Now let's talk about a problem that we, face every day, right? You obviously want to buy a company that is worth 10,000 crore, right? But again, the money problem, the reality, you check your bank account and you only have 1,000 crore lying around. So what would you think? Nah, this deal can never happen, right? But you know about Wall Street, it's not that simple. They always think in the other direction, right? What they think, yes, this deal can absolutely happen. And you know what? The company that we would be acquiring, it's gonna fund its own acquisition. Plus, the 9,000 crore that we don't have, bank is gonna lend to us, right? So, welcome to the world of leverage buyouts where debt goes does most of the heavy lifting, right? So, let's start small, right? What happens? You want to buy a home, right? That home is worth 1 crore rupees, but you don't have 1 crore in hand. What do? You have 20 lakh, you pay that as a down payment, you get a bank loan for 80 lakh, that is someone else's money, and you are the owner of that 1 crore rupee home, the asset. You now control the asset with 20% of your money, right? This is how it happens every day, right? Before LBOs, understand leverage with something familiar, right? You control a 1 crore rupees asset with only 20 lakh of your own money. Leverage amplifies control and returns. Now, for buying that 1,000 crore rupee company, you need the full 1 crore cash upfront, right? If you are opting for the traditional acquisition, most buyers simply don't have that kind of capital, right? Now, what happens in an LBO? We leverage our position. We have 200 crores in equity, let's say. We'll get a loan of 800 crores from the bank, right? And lenders. So, you are basically the owner of that company with your 20% equity, right? The genius part is the acquired company is expected to repay the debt using its own cash flows. The target company helps pay for its own acquisition, right? How? See, I'll give you a very simple example. We were talking about buying a company worth 1,000 crores, right? Let's say we bought it at a multiple of EBITDA multiple of, let's say, 5x, right? What is EBITDA of that particular company? 200 crores, right? Let's say we subtract the depreciation, right? Let's say 10%, 20, right? Not 10% of EBITDA, but let's say 20, right? What do we get? We get EBIT, right? EBIT of 180, right? Now we have to subtract the interest payments, right? So let's say we had a 800 crore debt, and let's say the interest payments is 10%, right? So what would we do? We'll subtract 80. We'll get earning before tax of 100, right? Let's say the taxes is 40%. So 40 goes here. We are left with net income of 60. Do you realize what actually happened here? You acquired a company with 200 crores of your own equity, and the company's EBITDA, the company's operating profit, was able to make sure that the interest obligations are taken care of, and you are still left with a net income. And you know what will happen the next year? This was the year 1. In year 2, what will happen? This would reduce. Let's say it's 70. This would increase. And you know what? When we are talking about LBOs, we are also focused, when we are acquiring a company, we increase the operational efficiency of that particular company. So, EBITDA would also increase if it's done in a proper manner. So, EBITDA would increase, the interest payment would decrease, and the net effect would be seen in the net income. This is how it works. Now, what what PE funds actually do is, as a company, they often bring in their own capital as well, but they also find out and raises capital from other investors, right? Those investors commit their money to the private equity fund. Now we have the fund. This is what basically equity was in the first place. In this particular example, this equity comes from investors and maybe in some cases PE firms as well, right? Then you find a target company. Now, what is the target company in this particular scenario? A target company would be something that is stable, a company with stable EBITDA, for reference, right? With stable cash flows, right? It should be a cash generating business. This is very important to maintain this liquidity and make sure this is held to our advantage. It should be a cash generating business, right? Then we opt for debt, which ranges in 60 to 80%, right, of the purchase price. We go to banks and lenders that provides us with basically the 60 or 80% whatever we need. Then we acquire the company, we close the deal and take the control. Then the operations continue, right? We have strong cash flows, right? Those cash flows helps in bringing down the acquisition debt. Here, debt is going down. Interest payments have been taken care of, right? And then we are earning a profit as well, but because we invested our business in it, we gave that business time, we helped increasing the operational efficiency. What happened? We increased the multiples. This was 5x, this maybe could be 8x or 10x after 10 years, right? We'll get a higher exit multiple. We'll sell later at a higher value or an improved multiple. The company pays for itself over time using its own cash flow. Investors put in little equity and get outsized returns, right? This is what basically happens. See, this net income of 60 crores. How much was your equity? 200 crores. What this net income amounts to is basically 30% of your equity. And this is a big return. This is a big number which would definitely help your multiple. Now, how to find out which company is actually suitable for an LBO? See, we have to make sure that we are having stable returns, right? The revenue is regulated and as well as regular. We can predict the cash flows because we have a major, right? 80% of the amount that we have is from debt. We have major interest and debt obligation. So we have to make sure that the cash flows are predictable, right? The goods that we are dealing it should be of recurring purchases. It should not be a one-time purchase, right? The brand should be strong and there should be a defensive demand even in downturns. This is very important. This should not have cyclic demands or anything else, right? It should be an everyday necessity, consistent cash generation and mature operations. You obviously, someone would be willing to sell their business in maturity, right? So what amounts to a poor LBO candidate is businesses which have unpredictable cash flows, high reinvestment needs. We are already putting in equity of 200 crores and a debt of 800 crores. We don't want to continue the operations in a way that after 2 to 3 years, the operation would demand an additional capital of maybe 300 crores, without which it couldn't work further, right? With no stable EBITDA is a major red flag. Cyclical or tech disruption risk should be minimal, right? LBOs thrive on predictability. The debt must be serviced reliably every quarter. High growth companies usually need their cash for growth, not debt repayments. Why did I say it should have mature operations? See, when we are in the stage before that, that is growth stage, what will happen is Your main focus would be making sure that you have enough resources to make sure any demand is met. You'll be reinvesting in factories, buying out more companies to make sure your SKUs are well established. Right? You are in the growth stage. You should not be focused on making sure that your debt obligation and interest obligation are taken care of. Right? So let's talk about a same company but no leverage. Right? We take out 1,000 crores from our own pocket and buy that company. Right? So the purchase price was 1,000 crore, your equity is 1,000 crore. Let's say you increase the operational efficiency and you sold it later for 1,200 crores. Right? This will keep it constant. Right? You work the same given leverage or no leverage. Right? You have a profit of 200 crores. So divide return on equity is basically the profit by your initial capital invested, which was 1,000 crores. So 20% return. But with LBO, what happens is your purchase price is again 1,000. Your equity was only 200 crores. Debt from bank comes out to be 800 crores. This was kept constant, right? This was kept constant at 1,200 crores. Now this debt is taken care of. Equity value, what becomes is, it was initially 200 crores because 800 was debt and 200 was your equity. But now what happened? Your equity doubled, right? This is 12. Now it is selling for 12,000 crore, right? So your profit on equity is 200 crores. Profit on equity is 200 crores. What was your initial equity? Profit was 200, initial was 200. You have a return on equity of 100. Right? So same company, same improvement, but 5 times the return. Debt amplified the equity returns dramatically. Right? So what happens is, we compared this scenario here, right? In first year, in second year, what was happening in this particular scenario? It is just translated here. Initial situation would be a company with a value of 1,000 crores and a debt of 800 crores with the equity value of 200 crores. But 5 years later, what will happen? The 800 crores would become 300 crores. You will be paying interest on this 300 crores, right? Which would eventually be done using company's cash flow. Here, the new equity value is 700 crores because you own basically 100% of that company, but you are paying debt obligation. When the debt obligations are taken care of, your debt is basically transferred into equity, right? Debt reduction creates equity value. The company did become more valuable. It's still worth 100 crore, but because you are simply paying a debt of 500 crores, you have done that successfully, which have increased the equity ownership stake from 200 crore to 700 crore. This is how LBOs turn debt into ownership over time, right? Now let's talk about the micro, meso and macro environment. So for the particular PE firm, this LBO is a return enhancement strategy. Across the industries, LBO helps in reshaping the corporate ownership. Companies get to be restructured, which could increase the efficiencies and being honest, sometimes jobs are affected, right? Talking about the macro, the economic activity, the private equity influences employment, capital allocation, corporate efficiency, and innovation incentive, right? But again, everything comes back to this: leverage is powerful, but leverage cuts both ways. It's a double-edged sword, right? See, things are okay unless and until the debt obligations are less than EBITDA. But the problems come to picture when you have already bought the company at a higher valuation, like maybe EBITDA of 10 or 20x, right? and you have a debt of 1500 crore with interest rate of 10%. Now EBITDA is only 100 crore, but only the interest obligation, leave the principal alone, only the interest obligation tends to be 150 crore per year, which leads to a interest coverage ratio of 0.67. Right, the company cannot even cover the interest from its operations. Right, and we have discussed this in the previous video of zombie companies. What happens if a company is regularly having this interest coverage ratio? This would particularly need more debt to make sure, so increase in new debt to make sure all old debt obligations are taken care of. Right, this would call distress, this would create a bankruptcy risk. Right, you will be forced to sell valuable parts of the business at unfavorable prices to make sure that those interest expenses are taken care of. There would be absolutely job losses. Restructuring often means layoffs to cut cost and service debt. Right, so we are going to talk about some of the historic evidence of LBOs. Right, so talking about the RJR Nabisco, if you want to know about a cutthroat Wall Street example, this is one. In the late 1980s, a fierce battle broke between the company's own management and private equity giant KKR. It became so dramatic and controversial that they literally wrote the best selling book and made a movie about it, which was called The Barbarians at the Gate. Right? It showed the world that with enough leverage, no company was too big to be taken over. But it also highlighted how massive debts can push a company to its absolute limits. Right? Talking about a golden example, we have Hilton Hotels, right? Which was Blackstone's triumphs. Right? Blackstone acquired Hilton right before the 2008 financial crisis, which looked really terrible at first. Right? But what Blackstone did, they basically focused on improving the operational efficiency, the brand strength, and smart timing, with which it came out to be the most successful private equity investment ever. Right, it also helps company go private which were once public. In 2013, Michael Dell saw that the public stock market was too focused on short term quarterly earnings. They basically reacted too eagerly and too violently for that, right, which made it impossible for the company to execute a long term tech pivot. So basically what Michael Dell did, he used an LBO to buy back his own company and take it private. This gave Dell the ultimate breathing room to restructure away from the Wall Street prying eyes and completely transfer business before successfully returning to public market, but a little later. Right? So it's not just taking debt and fulfilling it through the existing cash flows. We have to make sure whichever company we are buying out is, we are focused on increasing the operational efficiency. We have to make sure that the cash flows are sufficient enough to reduce the leverage. Every rupee of debt repaid increases equity value directly. We have to focus on multiple expansion, for which operational efficiency is very important. We have to sell at a higher valuation multiple. Better business plus better market sentiment is equals to a higher exit multiple. Right, let's say in the previous example that we took, what if the EBITDA actually grows from 100 crore to 150 crores? Right, this would be because of operational improvement. Debt would eventually after 5 years fall back to 300 crores. Right, so interest obligation would go down, valuation multiple would expand 8x to 10x. Let's say the multiple grows, we are able to achieve that market positivity. Returns would then become extraordinary, and this is the holy grail of private equity. So basically, just to summarize, how investors are buying billion-dollar companies without having billions. They come together, bring in investors, make them chip in, and they start with a small equity. They go to the bank, ask for a large debt, then they acquire a stable company, use their cash flow to pay down the debt and increase their equity value. So LBOs are essentially not creating money in a way, they are basically rearranging risk, and leverage is a amplifying factor here, which is actually turning and helping them make a profit, right? So this was the secret of private equity, which isn't buying companies, it's understanding how debt changes the ownership economics. Small equity, smart debt, company's own cash flow equals to massive returns. This is the LBO's playbook. Thank you so much for watching this video.